Now, insurance, we're looking at property insurance, think of car insurance, think of life insurance, and so on. When you think about insurance, this is personal in nature. You cannot assign your insurance without permission. Why not? It may increase the insurance company's risk of loss. For example, she drives a 20-year-old car. She drives 3 miles a week. She has no tickets, no accidents. Her insurance is $50 a year. I have a brand new turbo sports car. I drive 300 miles a week. I have 17 speeding tickets, 4 DUIs, and 6 accidents. My insurance is $50 an hour, okay? Would I like you to assign your insurance to me? Yes. Would it increase the insurance company's risk of loss? Definitely. Therefore, insurance is personal. It is not assignable. You cannot transfer it without the insurance company's permission. Remember when we talked about title insurance? Same thing with property. Not assignable. You cannot give that. It's personal in nature. Now, we look at insurance. We're talking about something called an insurable interest. What does an insurable interest mean? It means that in order to buy insurance, you have to have some interest that is insurable. That means that you must suffer some risk of loss. Now the question is, when do you have to have an insurable interest when you take out the insurance? If we're looking at something called life insurance, then you have to have an insurable interest when the policy is taken out. If we're looking at property insurance, then you have to have an insurable interest at the date of loss. So you don't necessarily need an insurable interest at each time. With life insurance, let's say she and I are partners in this partnership. If she dies, our partnership will suffer a loss. So we're allowed to have insurance in each other. Why? Because I have to have an insurable interest when the policy is purchased. Now, I buy a 5-year policy, but 3 years later, we're no longer partners. She dies. I'll still get paid, as long as I had an insurable interest when we got the policy. Versus property insurance. With property insurance, you have to have an insurable interest not when you bought the policy, but at the time of loss. I buy renter's insurance on my apartment, and it's 5 years. 3 years later, I move out. The 4th year it burns down. I don't have any loss, therefore I'm not going to collect. Why? Because you need to have an insurable interest at the date of loss. Now, do you have to own the property to buy insurance? No. I just gave an example. I'm a renter. What if you gave me a piece of property as collateral for a loan? Could I get insurance in it? Yeah, because if that's collateral and you back out, then I get the property. But if the property gets damaged, there's nothing to get. So the question is, what are examples of an insurable interest? First bullet, the owner of the property has an insurable interest. What is the owner? The owner, that is called fee simple. You own it outright. A secured creditor may have it if that is collateral for a loan. It says a lessee, right? If you're leasing the building, you rent it for 5 years, you can get insurance. The beneficiary of a trust, a shareholder in corporate property, a buyer of goods has an insurable interest as soon as the goods exist and are identified to the contract. Now, the one thing that does periodically show up is the next item, what's called a coinsurance clause. A coinsurance requirement, what is that? This says that we want to make sure you do not underinsure and still collect the full face amount of the policy. This is called a coinsurance requirement. So here's the deal. It says we don't want you to underinsure and still collect. So let's say, for example, you have a $10 million home. I know the whole house isn't going to burn down because it's spread out over 10 acres. I've got fire sprinklers, grass, la, 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 la. But the insurance company doesn't want me to buy $1 million of insurance. They want me to buy $10 million because then the premiums go way up. So what they do is they set up this thing called a coinsurance requirement. The purpose is to prevent me from underinsuring and still collect the full value of the loss. Here's the formula in your notes. It's basically the face amount of the policy divided by the required amount of insurance times the loss equals the result. Now, I'm going to collect the lower of the face, the loss, or the result. Let's pretend I have a $10 million home. Now, I don't want to buy $10 million worth of insurance because it's too expensive. Let's say my loss is $800,000. So I have an $800,000 fire. Let's say I only bought $1 million of insurance. Well, normally you'd say $800,000 loss, you bought $1 million, you should get covered. Oh, I forgot to tell you. There's a coinsurance requirement of 80%, let's say. That means I'm required to buy 80% of the fair market value, which is $8 million. So I only bought $1 million. I'm supposed to buy $8 million. Therefore, I'm only going to collect 1/8 of the loss, which equals $100,000. Therefore, I get the lower of this, this, or this. What's lower? $1 million, 800, or 100? 100. That's how insurance companies work. They go, look, we don't want you to buy $1 million. We want you to buy 8. Now, had I bought $8 million, then I would have gotten 100%. But because I only bought $1 million, I've only bought 1/8. I only get 1/8 of my loss. Now, this only applies to a partial loss, because if the whole building's destroyed, what do I get? I get the face of the policy, which would have been $1 million. But when it's a partial loss, that's when you only get a portion of it. Therefore, you only get a portion of it to make sure. So if you look in your notes, you'll see it says face over required times loss equals result. What do you collect? The lower of, the smallest of, the amount of the loss, the face value, and it says limit based on coinsurance clause. Ignore percentage if it's a total loss. So if it's a total loss, $10 million, then you get the lower of the two. Then it says more than one insurance company. Now, if you have more than one insurance company, that's called a pro rata share. Let's say I have a $1 million policy in one company and $2 million on another. That would be $3 million. I would collect 1/3, 2/3. So you get a pro rata proportionate share. That is called pro rata. That's how much you would collect. On the next page, it says life insurance coverage. As I mentioned earlier, with life insurance, when do you have to have an insurable interest? You need an insurable interest when the policy is obtained, not at the date of loss.